Hi, investors. It's Nick and
it's Martin. Hi from me.
Bit of a delay there. Yeah, so we're going to do these videos every couple of weeks, which is just a general overview of what's going on. But since it's this on in the marketplace, and since this is the first of these ones, I thought we'd start with macro level stuff and then kind of work down to this is happening here, that's happening there. Now, overall, I'm probably stronger on high level macroeconomic, high level shifts in housing. I'm also quite strong on data analysis and property condition assessment. It's just one of those things. And Martin is very strong on, well, what are you very strong on, Martin?
I'm more strong about the city assessment, like which allocations are best for invest in the cities, and analyze the properties, condition, location, mortgage issues, coal mining, flood issues, and so on. Detailed check for property, everything about the properties is good for investment or not. So basically follow the rental market and selling price every day, checking how much properties are selling, because we have updates on Rightmove Plus. So basically I'm following how the price is shifting and how much is increasing. So based on that, everyday following and also the data what we have, we can have like a general opinion about cities and locations. This is good, this is bad, and yeah, that's my.
So there you go. So with that in mind, I'm going to talk first because the idea is that once you have a general compass on what's going on, let's change the lighting on this. Sorry, it's a bit. Once one has a general compass on which way the things are moving, then it's easier to then zero down and look at specific cases. We're going to be doing city assessments in the future. So this is a project we're going to start working on over the weekend, in fact. And the idea will be we'll follow a set format. We'll look at a city and or areas within a city, do the main numbers, the capital growth, all those kind of things, and just come up with a general opinion on how this is looking. Anyway, but that's that. But right now, what I want to do is just share a screen with you and just quickly go through some stuff. Now, I've talked about this in other videos, but I've written an article which I constantly reference because it's important. And I've written a thing just going into my hypothesis in detail. But in short, markets work in cycles. This is 1845. This is today. This is 8 cycles, number 9 now, and possibly number 10 if you think of this little blip in World War I. And they always have the same kind of process. They always follow this cycle. And here is the actual data for the northwest of England. The southeast of England was counter-cycle in the last property cycle, this current cycle, should I say. So when everything else was crashing and flatlining, London was going up. So therefore, I think it's better to just look at an area which is the area that works for buy to let in this country when it comes to yield and growth and all that. And essentially what we're seeing is whenever this is equivalent to where we're at now, so the boom phase, a lot of areas don't crash that much, believe it or not, 10%, that kind of thing. But what really kills the value of property is not the price going down, but the cumulative inflation and properties remaining static in value. And thus, over time, the properties go down in purchasing power terms. Anyway, we're now entering in the next, we're not entering, we're now in the next bubble phase, as it were. And the cycle is really straightforward. If you look at affordability, there comes a time when it's just not very affordable, and there has to be a crash to allow affordability to return to norms. So you would say a sensible norm might be 30% of household income spent on mortgage payments, for instance. And bear in mind, this is a wonderful chart because it adjusts for different interest rates. So back in the 80s and 90s, interest rates were 5%, that kind of thing. but properties were a whole lot cheaper. Thus, you had relative affordability. So prices always adjust to affordability. And here we are, we're entering this current cycle. So the other thing I want to say about the future of interest rates, I believe interest rates are going to remain fairly low for at least 10 years, 8-10 years, that kind of thing. And the reason is it's very similar to the 1940s, where you had a boom, you had a crash, you had a war. Today we've had a boom, a crash. We haven't had a crash yet. Well, we had the 2008 crash, but yeah, we've had the 2008 crash, which would be the equivalent of the 1929 crash. And now we're somewhere around sort of post-war equivalent. And what happens in this phase is that for us in the UK, it's Brexit. So what have we got that challenges the world? We've got Brexit, post-COVID supply issues, onshoring, in other words, the reversal of globalization. We've got the Russian war, the Ukraine war, and then we've got conflict with, or impending economic conflict with China, i.e., in fact, part of the onshoring stuff. So the other thing to think about is government debt. In the 1970s, there was very little debt. The government could hike up interest rates and not totally nuke the country. So there was low personal debt, low government debt, and thus it was okay. They could jack up interest rates and everything would kind of be okay. But in the 1940s, we didn't have this. There was a huge amount of government debt, just like we have now. So this would be up here somewhere, 150, 200%. I don't know what the current numbers are, but they're high. And therefore, if the government raised interest rates, we're just in trouble. They're going to nuke the economy. So that's not going to happen. The likely outcome is high inflation. And that leads me into what I think is going on now, which is that I'm seeing firsthand, because the way it works with us is I do a lot of talking. I do the talking, as it were. So Martin and his team, they filter all the properties, work out which ones are interesting. We put them out to a group of, how many investors have we got now on all the different WhatsApp groups?
Let's say 400, 500.
We got lots of investors. We put the properties out amongst them, and then they hold up their, well, they message and they go, yeah, I'm interested. Then we organize viewings and I go and talk to the agents. The reason I do that is because I get really up close to the deal, and I'm the guy who negotiates and does all of the hustle and all of that.
Yeah, it's around
anyway,
400.
What I'm seeing.
Wow. I just check. Yeah.
That's very good. So where was I? Right. Okay. That was more than I remember. That's great. I'm seeing a shift, certainly in Manchester, and I think across a lot of other cities, where owner-occupiers are basically being pushed out. Now, pushed out of the marketplace, as it were. So broadly, what I think is happening is that, let's say from 2018, where the market was going sideways, there wasn't massive competition for property, but it was there, of course. And prices were relatively stable, but from then the market started to heat up. Then we had the COVID blip, and then we had a big injection of cash into the economy. Then we've had a lot of people with cash trying to buy. And I think the owner-occupiers are kind of giving up now. In other words, they've either bought the property that they were seeking over the last 8 months since COVID has relaxed a little bit, or they're starting to put so what I think is going on is that they've either bought or they're kind of giving up, and they're getting outbidded by investors. Now, certainly in Manchester, we've seen a huge influx of Hong Kong Chinese, and that's to do with the BNOB passport scheme. So in other words, they get visas, they can live here, and the Hong Kong dollar is strengthening against the pound, which is great for Hong Kong Chinese. But there's a new contingent in town, as it were, who are those people affected by inflation. The investors. And very simply, if you think of it like this, you're an investor, you've got £100,000 sitting in your bank account. If you say that inflation is 10%, remember that there's a real inflation number and then there's a kind of massaged one. So the CPI, I think, is 6 or 8%. I can't remember the number. It's certainly very high. But real inflation is probably higher if you take just unmassaged inflation numbers. So let's just be conservative and say it's 8% per year. So if you do cumulative inflation, remember it's not 8 plus 8 plus 8, it's 8 plus 8 plus 8. So in other words, true inflation, 5 8s are 40, plus cumulative inflation, 45%. So therefore, if you hang on to that £100,000, the purchasing power of your £100,000 will be the equivalent of £55,000 in 5 years' time. So if you forecast, you can only buy £55,000 worth of stuff in 5 years' time. So what do? Well, you quickly where you can get an income that is indexed with inflation, because rents increase with inflation because people get paid more, and rent is generally set at a proportion of somebody's income. So what I'm seeing now more and more is investors coming in and driving the market, and the owner occupiers not competing so well. It's never black and white. It's always just ebbs and flows and shifts. But I'm seeing a shift this way. And what I'm seeing is that we're now entering into the final boom phase. So again, I'm going to share my screen just to highlight this point. Right, so this is the affordability phase, and typically if you look historically, 88 through to 90, let's say, so 2 years in that cycle, but that was cut short because of an economic shock to do with, I can't remember what it was, but there was an economic shock anyway, and it was absolutely out of the blue. But this cycle from 2004 to 2008 is probably more indicative of what we're in for. In other words, 3 years of intensity, and arguably we're now in my opinion, we've got about 2 years left before it just collapses for some reason. Now you can try and reason it out and go, well, there has to be a reason for the collapse. This will happen, that will. No, this is the weird thing about property cycles. They happen. I don't know why, probably for numerous different reasons, but they always happen. So I've given up on trying to say, well, this is the reason it's going to happen. I don't know what's going to trigger it. It's probably something to do with affordability becoming untenable. It might be a shock, an interest rate shock. It's unlikely. It could be an economic collapse due to just huge stock market collapse. Who knows? Could just be aggressive inflation overbearing on people, and they just can't afford to pay the prices anymore. I don't know. But when a market does crash, it doesn't crash that much. You're talking like if this is Northwest, which it is, this crashed 25k of 150. So it crashed about 12.5%, 15%. And typically when I look at different areas and I look at the history, which I make a point of doing, I can see in different areas, here's Bradford, which is doing particularly badly at the moment. I can see how much a property market crashed in 2007 to 9 and all this kind of stuff. On average, for a decent area, it's crashing between 6 and 15%. So if you don't go crazy, you keep your gearing down a little bit, you'll be fine. But you won't be fine if you lose your mind and lose your judgment and start buying badly. Then and badly means compromised. So Martin, can you think of a compromised property that you saw recently that was just a really bad thing to buy?
For example, next to coal mining entrance, it will not be mortgageable. You cannot never refinance. Or we had a property who have structural issue. It have one part in Droitwich.
Actually, that was a good example. Yeah. Was that the one where we rejected it, but another buyer bought the one next door and they got absolutely screwed on it? Yeah.
Yeah, because basically it needs to remove the one wall and make a new wall in the front of the house. And it was risky because all the house can collapse because trying to do that. So so basically we try to avoid all the structural issues properties. Even if it have a small risk, it's better to avoid than to buy it and after have a headache because you buy a bad investment. So
the context. So really, just to kind of steer the conversation a little bit. Sorry, Martin, but if you think of this as a framework, right? So areas are getting overbought. It's getting dangerous out there. There are places in Manchester like Stockport. What are the really hot areas? Swinton.
Eccles, also far.
Just
Salford.
Which are aggressively overbought, aren't they?
Yeah, Salford, Swinton, Eccles, Stockport. Sale, those areas are like, if you want to go there and buy a property, it's a really nice area, really good demographics, the yields works and so on. But the problem with those properties is they are overpriced. For example, if the property is 220, let's say they're asking, it will sell for 250, 245, 260 even. We have one situation where a property was advertised for 180, it sells for 230. So it's like 50K more. That's like 30% more than the asking price. So it just, I will never purchase that much.
So again, this is desperate investors, and this is people who don't know what else to do, and thus they pile into these areas, think, well, everyone else is, it must be good. And this is how economic bubbles begin, by the way. And if you ever read into history, it's just a human condition that people follow other people because they don't think for themselves, and they think, well, if that worked for them, etc. And if you had bought like 2 years ago, then you would be 20-30% up already. But there comes a time when enough is enough. And where I think we've now shifted to is what they call the winner's curse phase. And this is where if you buy today, you will be down when it comes in the crash. So in other words, you buy for 200 today, it'll be worth 185 at the bottom of the market. And so therefore, certainly for me, I'm just thinking, well, I'm aware of this, and this is where I revert to Martin, actually, because Martin knows a lot of the details. Like in that circumstance, we know that these places, the overbought places, what's the alternative, Martin? Like what would you do in this circumstance? Areas, what characteristics?
I will just, if you really want to buy in these areas, you just need to be prepared to bid high, because and you don't need to fall in love with the property because it will have a lot of overpriced. So a lot of people, a lot of desperate people will want just to buy in this area, and that's it. So they will pay at 30K more. But when you think the yield will be 4.7 then, and with 4.7 is you will not have cash flow. So I think what you need to do is just look a little bit outside from Manchester, not just central Manchester. You have like good area in Moston, let's say. You have Middleton, you have Redcliffe, you have Little Hilton, you have like maybe even Lee is a good place. It's a good place for invest. Maybe it's not the best place for living because it's like poor end of, but for investing it's good because those people will never have money to buy a property, and they're not the worst people. So I mean demographically, so they will always need a place to live, and they will always want to rent. So and the rent is good, the yield is still good. So I'm just saying, like, just try to ignore central Manchester, around central Manchester, the houses, because they are too much overpriced. Yeah, better like if you have 250, let's say you plan to invest, better buy 2 properties in Doncaster. I think you will do much better.
Yeah, I agree. And so we're looking at, we're very interested in Doncaster, and we're also looking at Sheffield, parts of Leeds. I mean, there are lots of areas that actually work.
And
it's just...
Yeah, if you search a high yield, you can go with Crew, some terrace house, but we'll try to not find like a really bad structural issues, but who will be okay. If you take it, you will have 7%, maybe even more yield, still good. Capital growth is not the best, but in my point of view, if you want to have a huge portfolio of properties, you need to have properties who will have yield and capital growth. I will focus more on capital growth, but at least you need to have 2-3 deals. If you have 10, I will buy 2 with a more yield, and 8 will be more about capital growth. So like this.
I agree. We've done a lot of number crunching in this, and essentially, at the moment, you will make 8 times more wealth gain from capital growth than you will from net cash return, assuming you're a UK buyer, limited company. But well, no, foreign national about 8 times. If it's a UK, it's about 6 times. So in other words, your wealth gain through capital growth is 6 times greater. But we've got a problem, which is we're nearing the end of the cycle. So certainly in my case, what I'm going to be doing is gearing down, looking at 70% loan to value, so that there's a sensible cash return, looking at higher end demographic areas where people are economically robust, and looking at places where the herd of investors who don't quite know what they're doing but are following the next person, that lot, where they don't go. And a lot of that is just satellite towns around strong urban conurbations. So Manchester, I think, is such an interesting city. We'll talk about this in our city analysis series, but it's the main point is economic strength and good demographics. And there are deals out there, and my hope is that I personally find properties which are good, solid returns, grow in capital gain, but I'm not going to really care about that. I just want them to be robust in the crash. And then I'm playing the long game anyway. And so ultimately it's capital gain, but it'll be 10 to 15 years time, because typical property cycles are 18 years. And by then that capital gain will help fund my family and do all of that. Because with capital gain, you can refinance, extract the money out, it's proceeds of a loan, thus it's not taxable. That's a nice thing. So I fully expect that to be the case in many years to come. And the idea is you just hang on to the properties, never sell them. But the trick is not to overgear, I think, and to go for good demographics. Any tips, like practical tips, things to avoid, Martin, just when seeking a property?
Yes. So basically, first, like the main tips, location, avoiding like next to hot food, main road, near the school entrance, or near cemeteries, really near, or something like property need to be mortgageable. So basically, the location is also important for that, and also it's important for tenants, because no one will want to rent a property next to hot food or some commercial or industrial place. So basically, location is really important, and you need to check about the parking, at least to have on the street. The next and also important thing is flood risk and coal mining risk. So basically, try to avoid this. Better have a property 5.3% of yield than with no risk, ready to buy, ready to go, like do the renovation and all the cost, 5.3% of yield. Better this investment than some property who will have 6.5% of yield, but will have flood risk, or will have little bit coal mining, or location will be compromised, or the garden will be compromised, or a tree in the garden, or something like will make your life more difficult if you invest in this kind of property. Better buy safe investment with lower yield and good capital growth than good capital growth and good yield, but with risks. So try to avoid all the risks, what is possible. Also structural, everything what is possible, just try to avoid. don't buy too old terrace house like before.
Yeah, that's
Yeah, like it will have it, that's like 120, 130 years old property. It cannot be perfect, so it will have some issues. So try to avoid those. Better buy in Doncaster just saying, because I'm seeing a lot of properties like in M27 in Swinton, like terrace house before 90s, 900s. So
1900. Yeah.
yeah. So 120-year-old terrace house, 180 asking price, selling for 200, and in next 10, 15 years it will have some issues with structural or 30. So basically, better buy for 200, better buy 3-bedroom semi-detached house, newer, outside of Manchester, let's say, or 170 in Doncaster or Sheffield. Better buy newer property than an old. My suggestion,
Yeah.
like, don't search for old terrace house. Don't search for risky property. Buy safe property, safe investment. You will like sleep good, and you will not have headache every morning when you wake up what to do next with the property. So, and how to resell, what to do. So what kind of and also it's important, try to find good demographics around a good property. So,
yeah, and just to wrap up a few comments from me. So Martin touched on something, resale. The issue with property is it's a slow selling asset, relatively speaking. But if you are desperate, you buy something that's compromised and you can't resell it, you're in trouble. So the number one thing is make sure it's a resellable property. Then you've always got yourself covered, and you could just shift the property quickly if you need cash. The other thing is that with the landlord and tenant relationship, there's an increasing number of protections for the tenant, and where it's broadly going is that the social contract, i.e., the agreement that people make between each other, not a legally verifiable one, but a social contract, that contract is more important than ever before. And if you have a tenant who knows how to play the game, is on social welfare or falls into social welfare or decides not to, there are lots of tenants who are perfectly great who are on social welfare, by the way. But what I'm talking about are people who are economically vulnerable and they tip over into a distress situation, then they play the game, then you're stuck with somebody who's not paying their rent for 6 months. And if they decide to destroy your property in vengeance, because they might, there's nothing you can do about it. You won't be able to issue a criminal prosecution against them because, oh, it was an accident. Sorry, the tap was left. I didn't mean to leave the tap on. And what are the police going to do? They can't do you for criminal damage because it was an accident, or do the press. So the point is that in these strong times, it's really easy to just make compromises about buying that nasty little house that's a bit of a wreck, but you know you'll get good rent for it because everyone's desperate. But whenever I think about investing, I always think, how is it going to hold up in the bad times? Because the bad times will come. They always do. And if I feel a property will hold up in the bad times, then great. And the bad times are when there's less jobs around, there's less tenant demand, there's less property demand, and you don't have the money to do big repairs. So then where are you at? And the answer is it's that nice, fairly modern, like 40 years or less, 3-bed semi in a nice area with middle class area, with good steady employment, where you can accept a drop in rents and everything's going to be okay. Then you're covered no matter what.
Yeah.
So I think, it's all about, for the next couple of years, I think it's all about people remembering that the bad times will come and planning for it, and then you'll be fine. But if you lose your mind, as a lot of people seem to be, then that'll be an issue. But a lot of people, as I say, are just dumping cash. They're just doing their best to get out of cash as quickly as they can, and they're sinking it unwisely into properties that are never going to work.
Yeah.
Or if they do work, it's going to be a very long time before they work. So anyway, Martin, anything final from you, and we'll wrap up.
Yeah. For me, the last thing is like be aware what kind of properties you're buying, double check, be sure that you need it and it's good investment. Anyway, you can check our assessments for each property. You will see that if it's good or not, so you can decide, do you want to send offer or not. So, and the main important thing is like we tell the truth as much as we can. So if it's an issue property, we will just tell you and avoid, but mostly we double check each property. First the guys, Alex and Philip, after me and Nick doing assessment. So basically that's triple checking, and plus our system. So that's like 4 times checking before we send to the groups and send offers. So we are sure that you will be safe and buy a good investment. So
yeah,
that's like, and yeah, location, risk. Think about it before you send offer. Like, do you will have risk and what kind of risk you will have? As I said, we have properties who doesn't have really a lot of risk. So
yeah, we have lots. The reason we gather every single property that's published on Rightmove, Zoopla, and on the market. We bring them into our systems. We analyze them algorithmically. Basically, we run scripts that tell us about we do all sorts of fancy stuff, and then we've got the guys who analyze the properties manually, and then from there we can make judgments and stuff. But also, just to say, our business model is kind of different to your average property sourcer. So we don't promise below market value because there isn't such a thing. There's only compromises you're prepared to make. And the trick is to make the right compromises for you, whatever those are. A compromise could be, I'm going to pay a lot of extra money for this property.
Yeah.
It could also be, I'm prepared to do the renovation work on this. Or there's bad compromises. Oh, I'm prepared to buy this house that's literally under the motorway, beside the railway, near the loud factory that's also situated between the curry house. Now, those are bad compromises, and we don't make those compromises because it's a very bad thing to do. It's bad for your financial health. But yeah, so our business model is basically where we find the best properties we can, and we get there in the end with our clients. And it's more about when the right property comes up, our clients know that it's the right one, they go all in. And you know, that's the way we do it. So we lay out the truth as it is. So the truth of a property, we tell the story of a property as best we can. And we've done this for a while now, and we're getting pretty accurate, I would say.
Yeah.
Have a look at some of our assessments. There are lots of them in the playlist. You can see how we do stuff.
I want to add, like, don't fall in love with property.
Yeah, good point.
You will not live there. It's investment. So the tenants need to love and the numbers needs to work. So yeah, that's my final suggestion. Okay,
so this was the first of our things. And what we're going to do is just get more granular, talk about specific things in future conversations, fireside chats, as you might call it, you know, or general conversations. But anyway, I hope that's helpful, and good investing.
Yeah, happy investing.